Well, I think there are three big forces that are at work that have not existed in our lifetimes before. And they are a long-term debt cycle, and we've reached the part of that cycle where interest rates are at zero and monetary policy is a major driver. What this looks like in a world where we're going to print a lot of money, monetize debt, and so on. There are three stages really in monetary policy. And the cycle that we are in, the whole world cycle, began in 1945. That was the beginning of the New World Order. 1944, we established the dollar as the world's reserve currency. It was connected to gold. And then until 1971, that broke up. And so there was an arc which central banks have the capacity to produce demand by producing credit. Just sort of hit a button and poof, and demand rises because credit comes out. But when interest rates no longer are effective and hit zero, as they did in 2008, we go to a monetary policy, which I call monetary policy 2, which is the printing of money and the buying of financial assets. And with that, there was the implications of that. Lots of liquidity in the world, bidding up asset prices. And we had an environment which was very good for capitalism, corporate tax cuts. All of that caused asset prices to rise. And then, of course, it also contributes to the wealth gap. So this first influence, monetary policy, which I hope we'll talk about, the long-term debt cycle and monetary policy, is an overarching influence. And it's important to understand where we are in that cycle. Related to that cycle is also the wealth gap cycle, periods of prosperity that occur after wars, during periods of peace, because there's a dominant power that no one wants to fight, and you have a prosperous period. And during those periods, there's a lot of development of credit, a lot of also expansion of prosperity and so on, technology development, and that creates wealth gaps. And those wealth gaps, and then along with those wealth gaps, values gaps and political gaps develop. So our wealth gap is now the largest since the 1930s, and the political gap is also very large. And so that influence is a giant influence. So that's number two. And then number three, as the major influence, is the rise of a great power to challenge the existing world leadership of the United States. And these cycles have happened over periods of time. That competition, that wars of various types, trade wars and the like, is another factor. So those factors are in place and were in place before we had the coronavirus. The coronavirus came along and is a knockback, and it has big financial implications. But so I think those are the three factors. And now when we look at monetary policy, I'd like to get into what that means, what the value of money is, and how that affects the markets and the currencies that we're now dealing with. The limiting factor has to do with the demand for that money and debt. In other words, what debt is, a bond, is a promise to receive a lot of currency. And so when it gives no good return or a bad return, and there's a printing of a lot of currency, clearly it's not desirable relative to other things for private investors. However, the central bank can buy it too. And so the limit has to do with the limit of demand, and that limit of demand has to do with the central bank's purchases of that, because they can buy it and hence there's no problem. So you look at periods of time of where in history, where was the most of it that has ever taken place, and to try to define the limits. And the war years was an example. I think the most analogous period we're in now was 1930 to 1945. I'll explain the various ways that it was analogous, but more importantly, I'd like to deal with the question of the limits. And so you first had the Depression, and in that depression, and when you hit zero interest rates, you had the printing of money, and the buying of financial assets. And then you had a lot of fiscal policy. So programs that produced large deficits, which then were monetized by more of that. And then you went into the war years, and the war years, very similar to now in terms of the need for a lot of money and credit, produced an enormous amount of money and credit, but it was managed by the central bank in a way where they were de facto taking that on, and it was a good example of testing the limits of that. Now, we went into periods where, what is an alternative source of wealth? And as I say, it could be stocks, gold, it could be other assets, but those became the boundaries. What would happen in terms of this limit is if something transpired where the dollar as a reserve currency, the holders outside, made another market that was a better market. It could be gold, it could be stocks, or it could be an alternative currency. Like in the earlier session, which I listened into, China as a reserve currency, there will need to be an alternative process. When that happens, and I think it will happen, then it looks like a currency defense. What I mean by currency defense is if money leaves that asset, if those who are holding bonds don't want to hold the bonds because they have lousy returns and they're printing a lot of money and they want to go to something else, and that starts to accelerate, should that happen, then what that does is, as money leaves, it puts the central bank in the position of having to decide whether it buys more bonds in order to fill in that gap, or it lets interest rates rise. Well, they can't let interest rates rise. There's too much debt, and then also interest rates rising means that the asset prices all go down, and it's too vulnerable. So like all currency defenses, what it means is that they then have to accommodate that, and the act of accommodating that in and of itself is a big problem. Should that happen, that would be terrible for the United States. Earlier I heard about the discussion of the privilege. That's right, the United States dollar is a tremendous privilege, and we are certainly pushing the limits of that. And if we were to think that the dollar was to be any other currency because of us pushing the limits, if that were to happen, it would be probably the biggest disruptor, not only to the markets, but to the whole world geopolitical system. So we're in a fiat monetary system. What I mean is throughout most history, there was gold. Let's say 1944, we create the Bretton Woods system linked to gold. The United States printed a lot of money and more claims on gold than there was gold. And in 1971, which wasn't very long ago, we couldn't meet those claims on gold because we had too many IOUs. So we had a devaluation. And the dollar as a world's monetary system or currency is critical. But it very much depends on the dollar, the United States competitiveness, and so on. So it's a longer term risk. As Nouriel was pointing out in the earlier session, one of the things that's been a prop for the dollar is the fact that there's a lot of dollar denominated debt. So what that means, it creates a demand for dollars. That debt will either be satisfied in some fashion or another because there'll be the dollars to produce it, or that debt will be defaulted on in one way or another. That's a whole other discussion we can get into if you want. But at that point, it'll reduce the limit to the desire, the short squeeze for dollars, which will serve to weaken the dollar at the same time. And also, as we look longer term, as Nouriel was pointing out, the squeeze, the politicalization of it, changes the nature of the capital flows because we are in a situation where you can be squeezed. If you're China and you're holding $1 trillion of treasuries, would you want to do that? Particularly, given the returns, given all that, and given the conflict. So this China piece is a part and piece. As I say, there's three things. We're spending a lot of time discussing the monetary and debt cycle. The second is what I'll call the gap, the wealth gap and values gap cycle, and then the third is China. So if we look at those things in combination, I think that's the best way to look at the whole picture.